it's hard to go a day or hard to talk about ETFs without at least acknowledging the ongoing adoption of active.
All right, joining me will be Paul Baiocchi, Head of Fund Sales and Strategy at SS&C ALPS Advisors, who currently offers 25 ETFs, over $18 billion in assets. They've had a really nice year, taking in about $2.2 billion in new money. That's been led by the Alerian MLP ETF, ticker AMLP. But I'll tell you, Paul is someone who's an excellent all-around industry resource. He's been in the space for over 15 years. And so I thought it'd be fun to hear from him on which ETF stories have most caught his attention this year, and also what he's watching for heading into 2026. And I'll be doing more of this as we wind down the year over the next month and a half or so. I always like to get a variety of perspectives on everything happening in ETF land. So this should be an interesting conversation with, again, someone who knows the ETF space inside and out. Now, to start this week, I have another person who knows the ETF space inside and out, Todd Rosenbluth, Head of Research at VettaFi. And we're actually going to look at the most popular stories on ETFtrends.com over about the past month or so. Todd is going to walk us through where investors and advisors have been focusing their attention more recently, which I think longtime listeners know. I always like looking at this stuff because it's sort of a good sentiment check. It's a window into how investors and advisors are thinking right now. And so we'll take a look at those stories. And then we're also going to highlight several recent ETF milestones, including a pretty big one that happened last week. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let me now welcome in VettaFi's Todd Rosenbluth. Todd, thank you for joining me.
It's great to be with you again. How are you?
I'm doing great. And let's actually start by talking about a new ETF milestone, which is ETF inflows this year. So they just surpassed last year's record of $1.15 trillion. And of course, we still have, nearly 2 months to go here. So this could be an absolute shattering of last year's record. Now, I guess it could also go the other direction, right? But I'm certainly not betting on that. So what do you think about another year of $1 trillion plus inflows?
Wow. I mean, what a tremendous accomplishment. I think this is stronger than both of us would have expected after a record year last year. I know I thought we were going to see a bit of a slowdown, maybe not $1 trillion the second time around. 1.1 and counting, 1.1 trillion and counting. This is the best year in ETFs in terms of flows. We've seen overall demand for equities and fixed income at the same time when mutual funds continue to bleed assets. International equities were quite popular this year. They picked up the pace. We've seen gold and your friend crypto both have popularity in 2025. We're certainly heading into the end of the year on the best note possible.
Yeah, and just to offer a few other data points, which I love to bludgeon everybody with stats. So the actual number that I showed this morning in terms of inflows through current is $1.16 trillion. That includes $43 billion just last week. And if you look at October was a record month of ETF inflows, around $170 billion, which is just a ridiculous number. And then two other stats that I'll offer here. If you look over the trailing 1 year period, inflows have been over $1.4 trillion. And I wonder if that's about where we'll end up for 2025. And then lastly, ETF assets are now at about $13 trillion overall. So clearly just tremendous momentum. We always talk about how the fourth quarter of the year, there does tend to be an acceleration of inflows historically, and clearly we're seeing that. Now, besides annual inflows, there are actually a few other ETF milestones that I want to ask you about. And the first one is new launches. So we actually had another record last month, nearly 140 ETFs launched in October, which that brings new launches this year to 923 by my count as of this morning. The previous record was about 740 last year. And so, Todd, you look, I mean, we're easily going to go over 1,000 new ETFs this year. What do you think about that?
So I think that's tremendous. First of all, job security for ETF education folks like yourself and myself. But no, in all seriousness, uh, I think this is great. The ETF industry, as we talked about in the prior point, is at record levels in terms of demand. It's quite reasonable that the supply is at record levels as asset managers try to bring new ideas to marketplace. And we've seen it in a number of ways. We've seen, I think, what probably has caught many people's eyes are these options-based or leverage ETFs, single stock ones, or income-oriented, and that's leading the charge. And that's a narrower part of the ETF marketplace. But traditional active ETFs, so more stock picking and bond picking, has been quite popular. I noticed yesterday, I think it was half a dozen single state municipal bond ETFs from AllianceBernstein and Franklin had launched, or they converted from mutual funds to ETFs. In October, we saw Pictet and Raymond James enter the ETF marketplace, proving that not everybody is here. It's not too late for asset managers to enter the ETF marketplace. And then we at VettaFi, we were the index provider. We are the index provider behind a Rex ETF. It's focused on drones. It's a thematic ETF. The ticker is DRNZ. So this is not just active ETFs. That's the majority of products that have come to market. But we're seeing the supply certainly try to catch up with the overwhelming demand.
I like what you said about job security for people like you and I who cover the space and certainly offer education on ETFs. By the way, what's amazing about the number of new launches, and I know we've talked about this before, is just wait until the ETF share class fully rolls out. I trying to keep up with these ETF launches, it's nearly impossible, but it certainly makes for a lot of fun. Okay, a few other milestones I want to get your take on. Let's go back to inflows. So if you look, Vanguard just had its best month of inflows ever. They had over $50 billion go into their ETFs in October. That was obviously led by VU, the S&P 500 ETF from Vanguard, which that has nearly $110 billion in inflows this year. But overall, I show Vanguard now has $324 billion in inflows in 2025. Their annual record is about $330 billion. That was set in 2021. And I just keep saying Vanguard is simply a machine. It's ridiculous. Every single year I feel like we're having the same conversation. They just keep vacuuming up investor dollars. So any quick comments you would offer around that?
Yeah, so VU, Vanguard 500 ETF, was the first and only ETF last year to cross $100 billion. It's done it for the second time. I believe the record that it set last year was $116 billion. So by the time people are listening to this over the weekend, if they're listening to this over the weekend or watching it, we might be there, or we'll certainly be there by the end of November with a new record. But it's just great to see VTI and BND and BNDX. These are all building block parts of a portfolio that Vanguard offers $10 billion plus in each of those products. What I did note was that VUSB, which is an active short-term bond fund from Vanguard, is approaching $2 billion of net inflow. So it isn't just index-based products from the firm that many people know offering index-based products in Vanguard. They also are participating in that active demand.
All right, two other quick milestones I want to get to, and then we'll look at the most popular stories on ETFtrends.com. So speaking of active, I want to note a milestone you actually wrote about, I believe, yesterday, which is that Capital Group is right on the verge of surpassing $100 billion in assets, which I actually think is very noteworthy, just given they entered the ETF space less than 4 years ago. I mean, think about that, less than 4 years ago. And I remember some people, I'm not going to name names, thinking that maybe they were too late to the ETF party. But here they are, and they're now knocking on the door of being a top 10 ETF issuer. It's pretty remarkable.
Yeah, I'm not going to name names, but I will say that I won a steak dinner bet as a result of choosing in favor of Capital Group's efforts and success and how quickly they would come out of the gate. But even I'm surprised. $100 billion that they're about to hit is a tremendous milestone. Also, there's 17 different capital group ETFs that have more than $1 billion. They've now incorporated model portfolios that are using ETFs. CGDV, which is a dividend value ETF, $24 billion. But they also are seeing some success with fixed income. I think in my research, all of their fixed income ETFs combined have about $20 billion. So tremendous success, proving that 3 years ago, it was not too late to enter the ETF marketplace. Even the firms that entered this year, if you come to market with a distribution plan and you've got a brand to leverage and performance, there's room for you in the ETF marketplace to succeed.
All right, last milestone I want to ask you about. I think I always like to highlight success stories from smaller ETF issuers. And last week, Roundhill, they went over the $10 billion mark in assets. And what's noteworthy here is they've had over $5.5 billion of inflows just this year. So think about that. I mean, that's some significant acceleration.
Yeah, so MAGS, their MAG 7 ETF or Magnificent 7 ETF, MAGS, I think is close to $4 billion in assets under management. That's leading the charge, but they've had success with covered call ETFs. Again, up and coming firm, or not even up and coming firm, already proving themselves firm with $10 billion. Tremendous success to Dave Mazza, or tremendous shout out to Dave Mazza and team that have built this into a powerhouse, smaller firm, but proving that there's room for outside of the top 10 for firms to grow quickly.
Yeah, you mentioned MAGS. I was looking at this over the weekend. If you set that aside, that's clearly led the charge in terms of inflows. But I counted 13 additional Roundhill ETFs that have each taken in at least $100 million. And you're mentioning the options-based ETFs that they offer. About half of those came from the firm's weekly pay ETF suite. So, point is, this isn't a one-trick pony. And they are finding success, across a number of different areas. So again, always love highlighting smaller ETF issuer success stories. Okay, let's move on and look at the most popular stories on ETFtrends.com over the past month or so. And, before we do that, Todd, maybe you can start with why you think it can be instructive to look at these. I think it's probably obvious, but how would you describe this?
Yeah, so at VettaFi, our website's ETF trends and ETF database that are focused on the ETF ecosystem and community. We're publishing a lot of content specific to ETFs, one or two ETFs, and then covering the ETF marketplace. And so there's a lot of content that's out there. It always is interesting to see what has the advisor and the investor community found interesting and appealing to read. That can give us a sense as to, okay, what else should we at VettaFi be writing about? What else should asset managers be looking to talk about from their lineup of products? So I think it's informative. It's also great for me and our writers to be able to see that the content resonated.
Yeah. And again, I mentioned this at the top. I love this stuff because, again, it offers such a nice window into how investors and advisors are thinking. Okay. So we have 5 stories to highlight, and I thought, let me just tee up each of these, and then you can offer a little color, and perhaps we can bat these around. So the first story is nuclear energy stocks on the rise, get exposure to nukes, of course, referring to the Range Nuclear Renaissance Index ETF. So talk about this one.
Yeah, so I think last time I was on, I mentioned that Nukes NUKZ is an index-based ETF that's now tied to or within the VettaFi family. We recently acquired it. This ETF has performed really well this year because investors are looking for ancillary ways to play the AI theme. So there's clearly some spending that's happening for artificial intelligence by the technology-oriented companies that's driving data center demand, which leads to a need for supply of energy in a cleaner way. Nuclear energy has been a beneficiary of that. And I think our readers wanted to learn about an ETF example to get exposure to that. Last I looked, the ETF was up 70%. I don't know if that's still accurate. Probably should have looked before starting this conversation. But NUKZ, really popular fund this year, really popular or strong performing ETF. Readers resonated with it.
Well, lucky for you, I did double check performance, and it is up about 70% year to date. Of course, the S&P 500 is up about 17%. So substantial outperformance from nukes. And the other thing, I know we talked about this, as you mentioned a couple of months ago, but this ETF is nearing $800 million in assets. So you talk about another nice success story. This clearly fits the bill here between performance and investor interest. So it makes sense to me that this story would have resonated at ETFtrends.com. Now, you mentioned the AI component to that. The second story that we have from ETFtrends.com is AI marketing value highlights rising demand. And of course, AI does continue to be a significant story this year. So not a huge surprise that this would be there. But what did you think about that one?
So this story talked about why companies are increasingly turning to artificial intelligence. I don't think we broke tremendous new ground on that, but gave more of a practical use for it, and then highlighted an ETF from Alger, their AI Enablers and Adopters ETF, which is an actively managed and concentrated approach. The ticker is ALAI. It's an ETF that, as I also believe, you have data in front of you, I also believe has been performing tremendously well. And it's just another way for, we're finding that advisors and investors are looking to take artificial intelligence in multiple directions, and they want to learn more about it and figure out the beneficiaries.
It's interesting with that particular ETF because I remember, again, this was probably a couple of months ago, I visited with Alger's Arthur Nowak. I think it was back in September. So he's client portfolio manager there. And if you look at that ETF, it's a two-pronged approach. So the ETF holds both companies developing AI technology, but also ones that are integrating AI into their businesses. And I like that because I think perhaps you can capture the broader impact of AI here. So, again, an interesting approach, but that broader AI story, again, makes sense that would pop up as one of the most popular here recently. Okay, the third most popular story over the past month on ETFtrends.com, the underrated growth ETF signaling a buy to end 2025. And this refers to the American Century Focused Dynamic Growth ETF, ticker FDG. Why do you think this one captured attention?
I think that's a great headline. I think if I saw that, and I did see that when we published it, I'd want to go learn what was an underrated growth ETF. And so what the writer did for this was use Y charts to use technical analysis, saw some positive trends that were happening with FDG, that's an American Century ETF. And the focused approach is also similar to the one we talked about with Alger. I think we're starting to see more and more that investors are going beyond just the traditional approach to or what they had been doing with active ETFs, where we saw more the strategic approach, the dimensional funds, and Avantis, which is part of the American Century family, and some JP Morgan ones. There's not a lot of benchmark risk that's going on with FTG, and certainly some of the other stock picking based ETFs. It is. I think this is a great headline, and American Century's got a strong fund that's performing well.
A win for the VettaFi headline writers. Can we shine a light? Who actually comes up with the headlines there? Can we?
So the writers are doing so. I think this piece was written by Nick Peters Golden in particular, and then we have a wonderful team of line editors that also is making sure that everything works well and is grammatically correct, style is correct. A shout out to that team. Hopefully they're listening.
Do you ever have your suggested headline swatted down by somebody at VettaFi, or do yours usually make it through?
I think that the headline, if it's catchy, then I think it can work. But we're a team here, and I want the team to push back and offer a better way of doing it. So sometimes they've shortened my headline. Our headlines are intended to work well from a search engine optimization standpoint also. So I'll notice that it was a tweak. It was shortened. The same point got across. But they're doing their jobs, and I'm appreciative of them.
By the way, FDG, the ETF that we were talking about, that's up 22% year to date versus, again, 17% on the S&P 500. So performance helps here. along with a good headline. The fourth story, and Todd, this is another one that it makes a ton of sense to me. So the story is a dollar in decline supports case for international equities. And of course, international stocks have performed much better this year, finally. And I would say a weaker dollar clearly helps with that. What else would you note on this one?
Yeah, so this one was focused on Thornburg and their international equity ETF. The ticker is TXUE. And I think the goal of that article was to highlight the potential benefits of active management. So in getting exposure to international equities. So there's obviously low-cost index-based products from iShares, from Vanguard, from WisdomTree, among others, to give you exposure to international equities. The argument in this piece from the writer was, here's why you could look at active management to help navigate the risk and make sure that you have the flexibility in the global marketplace.
I'm hearing a theme here with the last couple of stories. Active management, which I do think will continue to be a story, obviously, into to 2026. Okay, the last story, and again, these are the 5 most popular stories on ETFtrends.com over the past month or so. Why Calamos's laddered auto-callable approach is resonating. And it's funny, I don't know if you caught this, but I had Bloomberg's Eric Balchunas on the podcast last week, and unprompted, he specifically highlighted auto-callables as an ETF category that most has his attention right now, which that surprised me a little bit, but clearly that fits with what your readers are interested in. So talk about this one.
Yeah, so the ETF that exists right now is CAIE, which is the Calamos Auto Callable Income ETF. I believe Calamos is bringing out a NASDAQ version of that in the coming days. I don't think it's today. If it is, then surprise to me and success to Calamos. But we saw this ETF, CAIE, or CAI, as I think I've heard Matt Kaufman refer to it as. It's accumulated over $350 million already. It launched in June. So that's a success story. We found that investors are looking for alternative income. This is an alternative income strategy. It isn't just a traditional covered call like what we talked about with Roundhill or JP Morgan offering. This is taking a differentiated approach. I think this article that Nick Wojtaszek wrote dove deeper into that category, or the fund in particular, and how it's generating an above average income.
Yeah, and the fact that this ETF has gathered that 360 million so quickly does show me there's going to be a lot of demand here, because it does take a little bit of homework to get your head around auto callables and how these work and where these fit. So the fact that this ETF is already having that sort of success, and of course, education will continue to come to the marketplace around this category, I think there's obviously a lot of opportunity here. Todd, did I see correctly? Is this your last ETF Prime appearance of 2025?
It is, because we've broadened out the rotation. So I want to thank you for all of the great conversations that we've had over the phone for most of the year. And hopefully people are watching that you and I are together. I'll look down for a second so I can see your smiling face. I love that we've pivoted to this. You're doing tremendous work with your efforts. And I guess I'll wish you a happy Thanksgiving. It feels really way too early to wish you anything in December. So I'll wish you a happy Thanksgiving, my friend.
Well, and I'll just say thank you for another year of excellent ETF coverage on here. Always love your perspective on things. You cover the ETF space as well as anyone. So thank you for that. And I'm sure everyone will look forward to seeing you in 2026. So thank you for joining me.
And I'll see you in person, if nothing else, at the Exchange Conference in March of 2026.
Hopefully we see lots of listeners there as well. That was Todd Rosenbluth, Head of Research at VettaFi.
Looking to put idle cash to work? Discover AMUN, Aberdeen's ultra-short municipal income ETF. Designed for high after-tax income and capital preservation, AMUN targets muni market inefficiencies with disciplined risk management. Invest smart, stay short. Learn more at aberdeeninvestments.com/active-ETFs. AMUN, where short-term meets smart strategy. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. To obtain a prospectus containing this and other information, please call 1-844-383-7289. Read the prospectus carefully before you invest. Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
I'm now joined by Paul Baiocchi, head of fund sales and strategy at SS&C ALPS Advisors, who currently offers 25 ETFs, over $18 billion in assets under management. And as I mentioned at the top, they have had a really nice year so far, about $2.2 billion in inflows. That's been led by the Alarian MLP ETF, ticker AMLP. And they have a number of other ETFs that have certainly resonated with investors. But Paul himself, he leads the firm's overall product development and distribution strategy. He's a tremendous all-around industry resource, and he's now joining me from Denver. Paul, welcome back to the podcast.
Thanks for having me. Good to see you as always, Nate.
You as well. And I'm looking forward to this because we're going to find out what has most caught your attention in ETFs this year, and then also look ahead to 2026. And I always love when we arrive at this time of year because I just like reflecting back on everything that's occurred within the industry and also peeking ahead. Always a lot of fun. I guess let's just jump right in and start with your, say, top 2 or 3 ETF stories of 2025. Obviously, a lot has happened this year. What are the top stories that stand out to you?
Yeah, so as we were talking ahead of the podcast, we were thinking about topics that would resonate with advisors and with listeners. And I think it's hard to go a day or hard to talk about ETFs without at least acknowledging the ongoing adoption of active and just how remarkable that is for guys like you who have been around the ETF world for so long and heard for so long about how active was coming and active was going to continue to displace passive and that we were going to see massive adoption of active. And it took a long time. I mean, you can go back to, let's say, the early part of the last decade, and we saw some success from firms like JP Morgan offering active short duration ETFs at a time where yields were really low. But beyond that, there wasn't much that stuck in terms of product launches and the active wrapper outside of, say, your core plus fixed income or short duration fixed income. And here we are, based on the numbers I'm seeing, $400 billion in net inflows into active ETFs in 2025, coming off of a year where active ETF inflows set a new record. And the split between active and passive just jumps out at me because we've got 750 or so billion in net inflows into passive strategies. We know there's noise in that number, and 400 billion in net inflows into active. That split is just so different than what you experienced over the course of the past decade plus of covering the ETF world. And it's just remarkable to me that advisors, investors, allocators of all shapes and sizes are coming to the ETF wrapper to solve all of their issues, not just cheap, smart beta, cheap passive, but also trying to improve upon the market through an active manager and being willing to hire an active manager in the ETF wrapper in a transparent manner. It's not as if these are semi-transparent strategies that are taking in the bulk of the inflows. Remember how much hullabaloo we heard about that. These are fully transparent strategies, which we were told was a hurdle for the manager themselves, and widespread adoption. It's remarkable. It's exciting, actually.
It's interesting because I know if you look back, a lot of people will put a pin in 2019 with the passing of the ETF rule. And of course, we got custom baskets, and there were some things that happened that made it much more. It made it much more efficient and easier to bring active strategies to market. And then, of course, we saw a lot of asset managers respond, and they started bringing their flagship strategies and their best portfolio managers to the ETF wrapper. To your point, besides that supply coming online, if you think about it from an investor perspective, what do you think have been a couple of key drivers as to why investors are looking at active? We get why asset managers have brought active ETFs to market, but why are investors?
Well, I think there's a subset of advisors who grew up in a framework where they used active managers to improve upon the market. They believe in some of the active managers that they've subscribed to, if you want to call it that, for a decade or more. And now they're able to align the best interests of their clients in terms of tax efficiency, transparency, et cetera, that the ETF wrapper provides with their desire to also access managers who they feel can provide outperformance. So I think some of it is the nature of the advisory landscape is still a fairly old demographic in terms of the key advisors in the country and how they've grown up in terms of how you deploy client assets and how you go about investing within the framework of an asset allocation. I would also say, to your point, the choice we're again in a year in which we're seeing record ETF launches, so they're not short for choice in terms of active managers now available in the ETF wrapper. And then on top of it, I think SPIVA has been the gospel for so long for the ETF world and has in many ways distorted how people think about active versus passive or benchmarks. And people have waken up to the realization that within SPIVA, there are categories where active managers can and have outperformed. Fixed income is certainly one of those categories. And then you get into more granular segments of the market. And SPIVA can be on your side in terms of active managers being able to durably outperform a given benchmark because people understand indexes more than they ever have, I would argue. And so they understand the flaws in, say, the BCom in commodities or the Barclays Ag in fixed income. And they think based on the managers that they're hiring in the ETF wrapper that they can improve upon that. And so I think a convergence of a lot of trends is at work here. But to your point, I think that the capitulation or maybe the turning point for active was also seen as the COVID environment where people were buying, say, an actively managed technological innovation strategy from a very specific manager. And that maybe opened up the door for asset managers to say, you don't need to be semi-transparent. You don't need to hide your holdings on a daily basis. You can outperform, you can get flows. And maybe that just changed the thinking of how people go about pursuing product strategies.
Okay, so we'll say the continued adoption of active ETFs, that's clearly one of your top stories of 2025. Any other stories that you would highlight?
Well, I think this one's related, and we talked about it a little bit on one of the previous podcasts we did together, and that's the ETF share class story, because I think one is related to the other. I think for the most part, people are thinking about bringing ETF share classes to their mutual fund family in active strategies, not necessarily as much in passive strategies. And so in some ways, is this jet fuel to the idea that we're seeing such widespread adoption of active ETFs because you have all of these legacy mutual fund managers who are going to be adding ETF share classes that won't necessarily require a new restarted live track record because they can point to the mutual funds track record over 10, 15, 20 years, however long it is. And to me, and I'm sure to you, Nate, having covered this industry for as long as you have, this ETF share class story felt like the boy who cried wolf. Well, this is the time that they're going to let the patent expire back in 2018. Well, it didn't happen. And then all of a sudden it does happen. Everyone's scrambling, and then we're waiting and we're waiting and we're waiting. And we finally get approval for DFA and what seems like off to the races. And we can talk later about, the outlook for 2026 and what we read into from an ETF share class perspective and the opportunity set there. But to me, that's the other big story here is almost, in Italian, you'd say finalmente, finally, this story is real and it's tangible.
I can't remember if we talked about this last time you were on here, but do you have any concerns that there will be too many active products coming to market, and it's going to be difficult for investors to differentiate between the strategies. I've sort of voiced this concern. I don't know how strongly I feel about it, but just I think about all of these ETF share classes coming to market, and I think about some of the active strategies that are out there where it's really hard to differentiate between them. They all look very similar. Is that a concern of yours at all?
Yes and no. I mean, we've had thousands of actively managed mutual funds for investors to choose from. And once upon a time, they could effectively pick any active mutual fund they wanted in their 401k plan. And then a lot of those strategies got consulted away, and these ETF line or these strategy lineups got condensed significantly and simplified in the 401k space. But outside of that environment, outside of that context, people have had exposure to thousands of actively managed mutual fund strategies. And it's really what the market will bear. So regardless of whether or not a legacy active mutual fund shop with a good track record, a good team, a good story launches an ETF share class, that doesn't necessarily mean that they're going to be successful in raising assets in the ETF. In fact, as we've talked about, and I'm sure you agree with, Nate, the ETF is not a panacea for what ails you strategically or what ails you from a business perspective. It's a very difficult, increasingly competitive marketplace. The bulk of assets still sit in very cheap passive strategies. And so while the pie is growing, we're north of $1 trillion in year-to-date inflows, and we're north of 13 trillion in AUM. The pie is growing, but the slice of the pie that active is competing for is somewhat small, even though we just went through how active is taking market share from passive. The choice isn't necessarily a problem right now. We're north of 4,000 ETFs listed in the United States. So adding more active strategies, I don't necessarily is going to overwhelm investors, because a lot of these advisors, a lot of these allocators are used to being star for choice in terms of all of the mutual fund strategies, just a different wrapper in many ways. And what the market will bear, we'll see.
Okay, so active ETFs, obviously the ETF share class structure finally being approved. Anything else you would point to as a top story of 2025?
It's hard to get away from gold, just given the year gold has had and some of the stories that we've seen around inflows into the large physical gold ETFs, the inflows we've seen into gold mining ETFs, and the retrospective, which is a little bit of hindsight bias that we've seen come about, where GLD, the largest gold ETF on the market, launched in 2004, and that story seemed to proliferate around, well, actually, if you go back to the launch of GLD, it's outperformed the S&P 500, which again feels a little bit hindsighty and retrospective in nature, but it speaks to the fact that gold has entered the lexicon once again. And typically gold comes and goes in terms of its relevance to investment media and investment stories. But for the time being, it's hard to avoid looking at the market on a daily basis, reading about the market on a daily basis, listening to podcasts like yours about the market on a daily basis, and avoid some conversation about gold. And I think in many ways that's reflective of a year in which advisors and investors have come back to the idea of reevaluating their asset allocation, the dominant role that hyperscalers, Mag 7, large cap companies play in that asset allocation framework, and some of the avenues you have to diversify not just your asset class or the types of companies that you own, but also the drivers of return and the risk reward profile of your client's asset allocation. And to me, that's a good thing. And it's not to sort of to pile on gold bugs, if you will, because they do tend to think gold's going to go up regardless of the backdrop. But it speaks to the fact that the ETF world is so entrenched in investment management in a way that wasn't necessarily the case 15 years ago or maybe even a decade ago.
I like that you picked gold ETFs here because they have had record inflows this year. And I've talked a lot about, if you look back over the past several years, gold has actually performed very well. And as you mentioned, even over the past, say, 3 or 4 years, it's outperformed the S&P 500. But for whatever reason, investors weren't diving in. And now this year that's changed. There's clearly a huge tailwind behind gold. And, we'll see what happens moving forward. I'm not into investment predictions or prognostications, but if we continue to see a weaker dollar and you think about the geopolitical backdrop and perhaps interest rates coming down. There's a lot of factors that could point to gold continuing to see sustained outperformance. I think that's a story probably to watch into 2026 as well. What's maybe one ETF story this year that has most surprised you?
Yeah, I would say the return of thematics. It felt like the idea of thematics and the story behind thematics was dead in the water for a couple years there, especially coming out of that 2020, 2021 market environment and the vicious drawdown we saw in 2022 in the types of companies that make up thematics, which are typically, in some cases, pre-profitability companies that typically get punished in an environment where rates are rising as quickly and as swiftly as they did. And this year seems to have reversed that trend. I mean, depending on how you define thematics, and everyone's got a different definition, just looking at ETF actions data, you're talking about 41 or so billion in net inflows into thematic ETFs so far in 2025. We've got just shy of 19 billion in quote unquote disruptive tech ETFs here in 2025. The infrastructure space has been popular. The natural resources category has been popular. The quote unquote industrial revolution theme has been very popular. We launched an electrification ETF in April that's gotten to $100 million in just shy of 7 months. And so in many ways, it's just a return in some ways to some of the trends we saw in previous cycles of ETFs, and thematics were this segment of the market, the segment of the ETF world that people paid a lot of attention to once upon a time, and that seemed to wash away over the course of the past couple of years. And 2025 seems to be a return to that, which is interesting to me, just because it speaks to the fact that advisors, allocators, investors, retail, institutional, and otherwise, are just coming back to the idea that the cap weighted view of the market doesn't always capture what you want it to capture. It's important. It's the baseline of most people's asset allocation, but you're trying to supplement and augment that to ensure that you get exposure to some of these companies before they're, like NVIDIA, 10% of the S&P 500 by weight.
I think that's a great point. That's actually what I was going to say as well. I think part of what we're seeing in the thematic ETF space, it's investors and advisors having concerns around that concentration risk at the top and looking at how they can round out their portfolio, maybe move away from some of that exposure. Because look, Mag 7, for all we know, can continue to run, continue to work. But if you're trying to build a diversified portfolio, there are a lot of other options out there. And I think thematics, that's an easy place to look to try to find some of those areas that, maybe become the next Mag 7. So that makes a lot of sense to me. I know we're talking broader ETF industry here, but I feel like we need to spend at least a few minutes talking ALPS ETFs, because ALPS has a very unique lineup. You do have thematic ETFs, like we were just discussing. You have MLP ETFs, dividend-focused ETFs, fixed income ETFs. What are maybe 2 or 3 ALPS-related ETF stories that I would say have you most excited?
Yeah, I mean, I previewed this a little bit, but ELFI, ELFY, or electrification ETF is just such a fun story to talk about, Nate, because we read about this massive CapEx cycle, and everyone's seen the Bloomberg chart with the circular nature of vendor financing and how all these companies are interconnected. And yet, a lot of people don't realize that the beneficiaries of a lot of that spend aren't going to necessarily just be NVIDIA or Supermicro or name the semiconductor company. They're going to be a wide range of companies in boring sectors like utilities. There are going to be companies in the material sector, in the energy infrastructure segment of the energy sector. And in many ways, what's interesting about electrification is those aren't necessarily the companies you own a lot of in your cap-weighted view of the market. If you look at the S&P 500, and I think we talked about this a little bit previously, utilities are 2 or 3% of the S&P 500 by weight. Materials, 2 or 3% of the S&P 500 by weight. Energy infrastructure within energy, which is just 3% of the S&P 500 by weight, has only 4 names in the S&P 500. And so in many ways, when you're thinking about drivers of rising electricity demand, it's AI data centers, it's consumer level trends, it's quote unquote reshoring. You own a lot of those hyperscalers in size in your cap weighted view of the market. Or if you own, say, the NASDAQ 100, you don't own typically a lot of the companies who stand to benefit from rising electricity demand in your typical cap weighted view of the market. And so Elfi in many ways is a fun story to tell in that thematic realm because it's different. People are reading about it. I mean, Citrini Research ran a piece recently that they posted for free on their website talking about that Stargate project and just decomposing a lot of what needs to ensure what's needed to ensure that Stargate is up and running and functioning at a level that it needs to. They're building gas turbines on site. They're effectively building their own power plant on site as other projects are doing, which means they're going to be piping in natural gas. It's all a massive tailwind for our economy and the future state of our economy as we try and realize these lofty AI ambitions and we try and reshore important components of our supply chain and as people switch from ICEs to EVs. But in many ways, people don't have a firm grasp on what it means to see electricity demand rise at the level that's being forecasted and how that flows downstream as opposed to the types of companies who are driving that rising electricity demand.
Okay, so the ALPS Electrification Infrastructure ETF, that clearly has you excited. And by the way, that just launched back in April. It's already had a very nice debut, both in terms of investor interest as well as performance. Any other ALPS-related ETF stories you would highlight?
So this maps back to the active story. SMTH is the active core plus strategy we launched just shy of 2 years ago with our partners, SEI, Smith Capital Investors, based here in Denver, headed up by Gibson Smith, one of the sort of few remaining bond kings left in the marketplace. That's a product that is north of $2 billion in AUM in less than 2 years since launch. And so we've benefited from the trends we talked about in terms of increased adoption of active ETFs. But it's also, as we go into a continued easing cycle, as the market is pricing in additional cuts here in 2025 into 2026, I think a lot of investors and their clients have been sitting in cash and thinking about the juicy yields that they've been getting there. And as short rates come down, they have to think about where you go to generate additional yields coming out of an environment where you've been able to get it from cash or cash equivalents. And SMTH is a product that we think provides an opportunity for those investors who are just looking to take on a little bit more duration, trust an active manager with a strong expertise and strong track record, great team in place, is a story we're looking forward to telling in 2026. And it's certainly been resonating, as you can see, with advisors and allocators as the growth has been just tremendous and is a tribute to all the work those guys do and the brand that they've built.
Yeah, that actually jumped out at me. I was looking at the numbers this morning, and if I'm correct, I show about 850 million in inflows into SMTH just this year. So you mentioned the fund itself being over $2 billion, but that clearly got my attention. Any other ETFs before we move on that you would highlight on the ALP side?
Yeah, just quickly, SDCI, which is a commodity strategy that is not active. It's differentiated from, say, the BCOM or the GSEI, the commonly followed benchmarks in the commodity space, in that it's pretty dynamic. It rebalances monthly to commodities that have a better term structure. So think backwardation versus contango. Performance has been great. And just based on where we're at in the overall dollar cycle, the easing cycle, this is typically when you want to start thinking about commodities. And we think SDCI is a really good product in terms of its ability to provide you with dynamic exposure to a category that's often dominated by energy and energy commodities, which may or may not be the segment of the market that you want to own going into 2026, given the uncertain outlook around economic growth and certainly the uncertain outlook around supply and demand and specifically crude oil. And SDCI has had really good performance. To your point around inflows, we've seen that product grow pretty quickly here over the course of the past couple of years, and we're really excited to talk about it going into 2026.
Yeah, that's another one. I think it's had something like $250 million in inflows this year. And that's no K1 on that commodity strategy, correct? Okay.
As the full fund name says, which is funny. You know?
That's right, yeah. Okay, with our remaining time, let's look ahead to 2026. So I'll just ask you, give me 2 or 3 areas you'll be watching. I would say broader industry areas.
Yeah, I'm going to try and be as quick as I can. And having done a couple of these with me, Nate, that's not my strong suit. But is the market going to broaden out? Seems to be one of the key questions. It's been so dominated by so few companies. The contribution to total return of the Mag 7 has overwhelmed the other 493 companies in the market. And is that going to continue? And are we going to see some contributions from an asset allocation perspective from things like small caps, from on a continued basis, things like developed ex-US and emerging markets? It's been a pretty good year for developed ex-US and emerging markets relative to the US market. It's been a pretty good year for things like gold, but will that persist into 2025, 2026? And will that include things like small and mid-cap companies? Will that include other pockets of the S&P 500? And if so, how do you go about positioning there? Do you look at things like an equal sector weighted strategy? Do you look at other developed ex-US strategies? And do you look for ways at a sector level to maybe reorient your large cap exposure away from the sectors that dominate? Technology is more than 30% of the S&P 500 by weight. Technology, comp services, and discretionary add up to more than 50% of the S&P 500 by weight. How do you go about reorienting away from those? And does it manifest, or do we just have another year where those companies continue to dominate the headlines and the market's performance profile? So that broadening out trade is one we talked about coming into this year. We'll see if that happens in 2026. I think the question that we're probably both asking is, how quickly does this share class, this ETF share class story actually translate to real launches and real live trading? That seems to be a real question, even for the companies that are first in line for approval, and whether the DTCC is set up, and if it even comes to be the type of market changing dynamic that some are forecasting. Or perhaps do we see other trends start to supplant the focus on ETF share class, namely something like tokenization, which seems to also be in the headlines quite a bit, not just in terms of speculation, but in terms of predictions. And so those two trends are top of mind. And then, private markets are always going to be in the consciousness of investors because of how quickly we've seen private debt, private credit, private equity strategies proliferate. And we're starting to see some maybe cracks in the facade in terms of revaluation of some of those individual credits. And if we see a sustained push into the ETF wrapper and some of those private markets, how does that actually work? And are investors even open to investing in those categories in the ETF wrapper?
Okay, so if I were to just recap the three stories you're looking towards in 2026, whether or not the market continues to broaden out, if some of the pockets of outperformance we've seen this year outside of, say, the Mag 7, if we continue to see that, and then clearly just how quickly the adoption of the ETF share class, the implementation of the ETF share class happens, and what that means for the ETF market, and then private markets and ETFs, which I agree. I think that'll continue to be a story as well. Though I would say there was a lot of hype around that one coming into 2025. And from my perspective, investor interest around at least the products on the market has underwhelmed. I guess I'll just ask you, let me ask you one follow-up. Let's come back to the broadening out. And I'm not going to hold you to this, but we are looking ahead to 2026. What is your expectation? Like if you had to guess as to whether or not we do continue to see other areas of the market sort of take the baton, do you think that's what we're going to see, or do you think it's going to be more of the same where the Mag 7 leads the charge?
Well, I think it's prudent coming off of back-to-back 20+% total return years, and then what's at least shaping up to be another positive, maybe 10+ performance year for the S&P 500, to evaluate your risks. And because technology has grown to north of 30% of the S&P 500 by weight once again, even though companies have been kicked out along the way, right? They kicked companies out to the communications services sector. They kicked companies out to the financial sector, GICS being they in this case. It's probably prudent to think about ways you can bring down the risk profile of your portfolio, and even perhaps think about ways you can bring down the valuation of your portfolio. And given that technology is trading at such an extended valuation, and so many of these companies are being priced as if they are going to continue to grow at the levels they're going to, even though the massive CapEx budgets are eroding the operating cash flow that people come to those companies for, it's logical to think about other segments of the market. And when you think about something like utilities, just as an example, a sector that's historically defensive, maybe has some growth profile that it didn't have in prior cycles by virtue of the massive CapEx that's dedicated to electrification, improving the grid, and ultimately trying to accommodate all of the necessary investment that's going to be required to allow us to realize this increasing electricity demand without too much impact on the consumer. That's an example of a sector that has a very low weighting in the S&P 500 and is positioned in theory to benefit from this long-term trend of electrification, but maybe might be a way to use technology as a source of funds to go and reweight to a more defensive segment of the market while also providing some upside.
Well, Paul, this was fun. I'll tell you, for one, I don't think you talk too much. I always enjoy hearing your perspective on everything. It's always great to connect. Thank you for joining me this week.
My pleasure. Thank you, Nate. Have a good one.
That was Paul Baiocchi, Head of Fund Sales and Strategy at SS&C ALPS Advisors. That'll do it for this week's ETF Prime. I want to thank one of our sponsors, Whole Tactical. If you would like to learn more about how the Whole Tactical US ETF can complement your S&P 500 exposure, visit wholetacticalfunds.com. Two great guests for you next week. I'll be joined by Greg Stum, CEO of American Beacon Partners, along with Jason Greenblatt, Senior Portfolio Manager and Director of Corporate Credit Research at American Century Investments. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.